Welcome back. Let's take a look at futures indicating a decline at the start of trading this morning. Dow Industrials down 160, Nasdaq down 120, S&P down 28 after the Federal Reserve paused the rate hikes yesterday. Federal Reserve Chairman Jay Powell said that the Fed is still looking to bring inflation down to a 2% target. Watch this.
We're prepared to raise rates further if appropriate, and we intend to hold policy at a restrictive level until we're confident that inflation is moving down sustainably toward our objective. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time.
Joining me right now is AmeriVet Securities head of U.S. rates, Greg Faranello. Greg, good to see you. Your reaction to the Fed yesterday?
Good morning, Maria. So largely as expected for us, obviously the market was not expecting the Fed to move on rates, which they didn't. We'll call it a pause, maybe a skip. So let's talk about what they did do, right? So if you look at the projections, first of all, if you look at the overall summary of economic projections for the quarter, it was kind of interesting in our view, right? They raised their GDP forecast. So they're saying the economy is going to be doing better. They have the unemployment rate going up, but they lowered that rate relative to June. So they have that now at 4.1. So the chair is saying that that natural rate of unemployment is actually lower post-pandemic. They have inflation coming down to target by 2025. And they have interest rates coming down over time. So it sounds like this grand scenario that we all wish would pan out, but in some ways the numbers don't necessarily make sense. And then in conjunction with that, I think bigger what they've done for the market short term, and in particular with the rate market, the rate cuts that they had priced in to 2024 and 2025, they lessened those cuts. So they still have rates coming down, but now instead of 100 basis points in 2024, they have 50 basis points. And in conjunction with that, we've seen the Treasury market reprice after the Fed meeting and into this morning.
Yeah, it sounds like those rate cuts aren't happening until well into the end of the year next year. Mark Tepper, you agree with that? Jump in here.
I do. And Greg, I want to talk about how, the Fed meeting yesterday and some of their expectations are actually going to impact the consumer, because this higher for longer theme seems to be real. I mean, they're not expecting the Fed funds rate to drop below 3% until at least 2026. The long-term target is 2.5%. And I think the biggest thing consumers need to come to terms with is that we're not going back to that 0% interest rate environment that we had for roughly 13 years. That may never come back, at least for the very foreseeable future. And as Americans, we have become addicted to a lifestyle that involves us living off cheap debt, being able to get a 3% mortgage. And I've talked to people who have 7% mortgages. Maybe they went adjustable rate so they could save a little money. They intend on refinancing once mortgage rates come back down to 3 to 4%. But I don't see that happening anytime in the future. What's your take, Greg?
Yeah, good morning, Mark. Those are all great points, and I agree. Investors, consumers need to come to terms with the fact that this rate structure may have changed, maybe not forever, but certainly may have changed for a long period of time. It's funny. I was talking to someone recently who was in the housing market, in the market to buy a house, and certainly of the younger generation. And he said, Greg, look, all I know are zero interest rates. I don't know anything else. So when I look at these mortgage rates, it's a little bit of sticker shock. So, higher for longer is definitely a powerful theme. My view, and we've been writing to clients, and look, the Fed may disagree. They've got, these fancy studies that they do in terms of lags of monetary policy. I'm not too sure how you feel, Mark, but I don't think we have fully felt the impact of these rate increases yet.
Yeah.
And I think if you look at when the Fed really, call it, hit the gas on these increases, it was last summer. So those increases are still flowing through. And then we could talk about, commercial real estate, resets on residential arms. We could talk about all this Treasury debt that we're issuing that's coming due. We're going from 1 to 1.5 coupons now. We're going to 5% coupons. I mean, all this stuff, I think, is going to ultimately bite. And that's what will prompt the Fed to lower interest rates.
Yeah.
But and even at that, though, they don't necessarily, this doesn't mean, and to your point, Mark, it doesn't mean the Fed is coming back down to zero. we could lower interest rates and still be high at 3.5%, 4%.
Yeah, for sure. And, Bob Nardelli made the point that you're making last week on this program, whereas some of the middle market companies that he's invested in, they've seen their interest payments go from $2 million to $14 million because they're now feeling the impact of those higher rates. So I agree. We haven't felt the full impact. Layer on top of that, a UAW strike enters day 7 today. Stellantis and General Motors laying off more than 2,000 workers. That announcement yesterday after Stellantis cut 370 jobs last week when this strike began. The stocks are down this morning, Greg, but we are also watching FedEx. FedEx shares are up this morning. It was a mixed quarter. The company's profit topped expectations. They raised the full year earnings expectation. They said they benefited from the UPS labor talks and the Yellow bankruptcy. The stock is up 45% year to date, another 5% this morning. Although it was a mixed quarter, your reaction to what all of this news means, whether it's the UAW strike and or the impact on profits?
Sure, it's a lot within a short period of time. We have the situation which you've covered, Maria, obviously on the government side and the potential shutdown. So we pull it back for investors. We pull it back to the prism of what does it mean for the economy, and then what does it mean for the Fed? And yesterday Powell was certainly asked about this, and he said, look, we're going to have to sift through it. For me, we tend to look at these things, even like the debt ceiling, we kind of feel in some way, shape, or form they're going to come and go. So we operate from that sort of core thesis.
Right.
That's not to say there's not going to be pain in the process. With regard to UAW and the strikes, I mean, look, we're seeing this across the country, right? The troops are banging on the table and they're saying we have inflation in this country. Inflation is driving wages. It's not wages driving inflation. And that inflation right now is coming out of Washington, D.C. And the workers are saying, look, we haven't been paid. We haven't gotten raises in a long, long time.
Yeah.
We need more money here. So from me, from a macroeconomic perspective, although wage increases have subsided somewhat, we still think they're going to be sticky.
Yeah, it's tight.
And we still think core inflation is going to be sticky. And that's what's going to drive the Fed to stay higher for longer, if not even notch a little bit higher from here.